Good morning, and thanks for tuning in to the last stocks to watch of 2020 on BloombergQuint. I'm Mathew, and my guest today is Dharmesh Kant. Good morning, Dharmesh, and thanks so much for joining me. It's a day when 14,000 on the Nifty could well be broken, but we're not going to be talking about that. We're, in fact, going to talk about a few distinct ideas. One of them, in fact, is the steel space, and Tata Steel in particular. There is some guidance that has been given by the management, in fact, by the MD and CEO TV Narendran, and he said that in 2021 the company is optimistic about demand for steel in India. He's also said that the company expects steel demand to grow proportional or higher to GDP, which is actually quite a bit of growth considering the low base of FY21, and this is in FY22. He's expecting that steel prices will remain firm, and he's also saying that the demand supply situation favors steel production with strong international prices. Now, there is, of course, the overhead of iron ore prices and coal availability and all of that. But what do you think about Tata Steel as the pick from the basket of steel producers?
Yeah, good morning, Alex. First of all, wish you and all your viewers and the entire team at BloombergQuint a very happy and prosperous 2021. It should be more healthier than what it was in 2020, and much more healthier and prosperous than what the market has been for all of us. That is what our wishes. Coming back to Tata Steel and the steel consumption and production in India, I think steel industry has done phenomenally well given the kind of headwinds it was facing in the calendar year 2020. And going forward, the outlook does look very optimistic. I totally agree with what the management of Tata Steel has to say regarding the steel outlook in India. But let's not forget, China is there with waiting to again capture back the demand which is coming back into the global economy. And Tata Steel has its own headwinds when it compared to European operations. Europe the activity has been very bad out there. There has been a second lockdown. And I mean, the governments have not enough money to fund the infrastructure, construction and activity out there. So I think it will be majorly a India play as far as steel is concerned. And if you look at Tata Steel, I think there are better options available if you want to play a steel theme in India. Maybe a JSW Steel is a much better play. So steel, consumption may be higher than GDP. And government of India has no choice but to, boost infrastructure activities in India, because that's the maximum employment generation kind of an activity. Having the run-up which Tata Steel has seen, I mean 640, I think it looks very expensive compared to the balance sheet and the return on equity which it has. If you compare that to JSW Steel, it's a much better, comfortable debt to equity ratio. Steel as a theme is, looks very attractive to me. Maybe a 5-6% kind of a correction if it comes by, as it happened last week on Monday. So that type of correction maybe nice to get into it. But JSW Steel would be my preferred pick over Tata Steel.
All right, that's a fair call. Let's in fact talk about the next idea, which is cement companies. And we saw quite a few of them jump quite sharply in trade yesterday. If I were to hazard a guess, perhaps it's on account of a brokerage note that suggested this is ICICI Securities that said that seasonal price hikes are likely for cement companies in January. And that is really a touchy point, isn't it, Dharmesh? At a time when there is an investigation into cartelization in the cement space again with respect to price increases, it is a bit of a touchy topic. So when somebody comes out and says they are expecting that there will be seasonal price hikes in January as they have been in the past, perhaps the street is taking some heart saying that, okay, these guys know something that we don't know. But what if that doesn't come to pass, right? And what is your pick in the space?
See, Alex, I mean, this quarter, Q3 of FY20 for all, steel, I mean, FY21 will be better for cement manufacturers. There will be volume growth as well as blended realization. Both will be good. So that number is already been discounted in the price. And historically, if you see, they always, when there has been 3-4 price hike by cement companies, there's a noise about, price hikes being taken, inflation getting higher, and government does raise its concern regarding the cartelization kind of a thing. This has been a historical trend, and government at best they just issue a warning statement that please take care of it, otherwise we are looking into your activities. So similar sort of note was given by Mr. Nitin Gadkari. He just sounded that steel price hikes and cement price hikes are hurting the viability of infrastructure projects which are rolling out. So that overhang remains. So Q3 would be good. Going forward for Q4, I think the volume demand will still be there. So that will continue the way it has been continuing. Price hikes, I doubt. If a nominal price hike to adjust the inflation part of the input prices, if it is there, that will still be there, but nothing material to take care of expansion of margins or expansion of profitability. So that caveat has to be borne in mind. Having said that, one should be a buyer in cement companies. I mean, the top line has already run up quite high, but still there are better options in mid and small cap space where you have multiple opportunities. To name a few, like Dalmia Bharat looks very good to me, even at current levels, and it has scope to go up further. JK Lakshmi Cement, JK Cement are other two topics in the segment. So I would be sticking my neck out for cement companies, particularly in the mid cap space like Dalmia Bharat, JK Lakshmi Cement, JK Cement, or a Prism Cement.
Mm. And considering some of them ran up very, very sharply yesterday, for example, India Cements running up as much as 20%, hitting an upper circuit in trade yesterday. The last counter that I have to talk to you about is Kansai and Nerolac. And, I must point out, Dharmesh, that over the past weeks, at some point, we've actually come up and spoken about Asian Paints. We've spoken about Berger Paints. Perhaps I haven't spoken about them with you, but I have spoken about them with my guests. And they have overall been positive on these two counters. Kansai Nerolac perhaps catching up with the other two to a certain extent in trade yesterday, up about 8%. It saw significant delivery buying as well. What's your view on this counter?
So, Alex, I mean, catching up theme is good, but I think if it's the catching up on the business fundamentals, it would be more comforting than the stock price catching up just because Asian Paints or Bergen Paints have done quite a bit. Strictly speaking about the matrices, I think Asian Paints have delivered a much better growth number, and their margins are much higher than what Kansai Nerolac boasts of. Even the return on equity is just half of it. I mean, 29-30 is the ROE of Asian Paint, whereas Kansai Nerolac is only 17-18 kind of an ROE. Even Bergen Paints say return on equity is higher, and the operating margins are higher than what Kansai Nerolac is trading at. So, given the facts of the business fundamentals which are there, and that is how the positioning has been. Asian Paints have run up quite a high. Berger Paints has also seen a significant run up, and Kansai Nerolac now is catching up. Paint as an industry look very attractive to me, given the input prices have not gone up so high, and they are still under controllable bandwidth. And at the same time, volume activity will pick up. It will go for the next 2 quarters as well. So no, doubts or caveats on the business front. It will continue as usual. Given a choice between Berger and Kansai, I would prefer Kansai Nerolac at current valuation multiples. Maybe there's more 50-20% kind of a catch up left out there. But having regard to a long term, if you're asking me for, entire year for calendar year 21, so I would be still sticking with Asian Paint rather than a Kansai Nerolac.
Choose the leaders in the space is really the broad theme, I think, of 2020. And that seems to be continuing into the new year. Dharmesh, thank you so much for joining me on this
Thank you so
program.
much.
It's been a pleasure.
Thank you so much.
And to you, dear viewer, thank you so much for tuning in for the last Stocks to Watch of 2020. We're looking at a possibility of 14,000 on the Nifty. So do stay tuned. You'll find all of the updates here on BloombergQuint. Have a safe New Year's Eve, and we'll be back tomorrow with more.